A plan for change. Hey guys, welcome to this week's edition of Friday's Food for Thought. The reed which bends in the wind is stronger than the mighty oak which breaks in a storm. Now, though centuries old, this familiar quote could have been written for us, reverse mortgage professionals. The last 2 years have given us both numerous and monumental changes to the federally insured home equity conversion mortgage program. That goes without saying. Now, the change is here to stay, regardless of our misgivings, approval, or apprehension, which leads us to the question, how can we prepare for change? Now, here are 5 points to ponder in your planning for 2015 and the brave new world of reverse mortgage lending. Number 1, adjust your mindset. This perhaps is our most challenging task to date. Even if we strongly disagree with distribution limits, the financial assessment, or the seasoning requirements for non-HECM liens, we must first get ourselves into a mindset of acceptance and implementation. Now, the good news is we have a few months to settle our misgivings and concerns before we reach out to potential borrowers once the financial assessment is fully enacted. If we skip this step, our prospects will sense our hesitation or lack of conviction in the program and respond in kind. Number 2, prepare your approach. Rather than a script, write down the steps you see yourself taking to interview, qualify, and gather the required documentation for the financial assessment. How will you present the need for this information? Also, how will you answer skeptical borrowers who ask you why you need such details? The better prepared we are for the process and our responses, the fewer potential borrowers will reject the process required to get a reverse mortgage. Number 3, put the pieces in place. Work with your lender to stay informed on how your organization is preparing for the assessment. What forms can you anticipate? Also, what software or tools can you use to pre-qualify a borrower? Now, due to the recent release of the financial assessment guidelines, do not expect to see software tools for qualification until February at least. Now, in the meantime, experiment with running hypothetical scenarios to familiarize yourself with the math, guidelines, and the criteria. 4, re-examine your market. Now, if you're primarily marketing to areas with low income and low home values, be prepared for a larger percentage of potential borrowers to fall outside of assessment guidelines. Which leads us to number 5, diversify your approach. Look to market to varying different types of groups and focus on a broad spectrum of home values and average household incomes. Also work on building your referral network with professionals who can refer potential borrowers and whose services you may be able to recommend in the future in kind. Now, there's no perfect plan for change, but a plan built on flexibility and diversification will help us weather the rapid pace of change foisted upon us. Now, what suggestions would you add to plan for change next year? Leave your thoughts in the comment section below and have a great weekend.